Good afternoon and welcome to this afternoon's breakout session on unlocking the energy efficiency market. In the next hour, we'll be looking to discuss the key drivers behind the development of this market in the UK and also the factors that are maybe holding this market back. My name is Jamie Mehmood. I'm responsible for the development and delivery of the Sustainable Energy Strategy for corporate clients at RBS. I'm pleased to be joined by a panel here today that can provide a broad range of different perspectives on this subject. We've got Ewan McVicker. Ewan's a partner at Pinsent Masons. He's a well-known market participant who specialises in energy contracts, trading and regulation. In 2010, Ewan was named the Legal Advisor of the Year at the Scottish Deals and Dealmakers Awards. Next to Ewan is Paul Brewer. Paul is a senior partner at PricewaterhouseCoopers, also a member of the finance subgroup of the 2020 Climate Change Delivery Group. Next to him is Chris Hayes. Chris is a sustainability manager at Skanska, one of the world's leading construction groups. Skanska has undertaken a range of measures, which we'll hear about hopefully shortly, at one of its premises, Hollywood House, and is now looking to roll these out further. And finally, we have Malcolm Snowy. Malcolm sold his business in 2005 and is now the owner of Scott Heating Company, which specialises in the supply to businesses of biomass heating systems and the provision of high-quality, sustainable biofuel. Before I ask the panel to outline in a bit more detail the role that they and their organisations play in this market, I'd just like to set the scene. As touched upon by the First Minister yesterday, energy efficiency measures are, alongside an increase in renewable generation, a very important component in delivering on the UK and Scotland's 2020 targets. These measures were also described yesterday in one of the breakout sessions as the low-hanging fruit. To be clear, today we're looking to specifically look at non-domestic energy efficiency with an emphasis on the private sector, given some of the emphasis in the breakout sessions yesterday on the public sector. I think of this as there being three key drivers that are building momentum in this market. The first of them is the rising cost of energy. Having seen significant price rises over the last few years, it's largely accepted now that these are likely to continue to rise in the future. The impact of this can be significant. One supermarket who we spoke to explained how, based on the market projections and the store opening plans, their energy spend was expected to more than quadruple by 2020 to the equivalent of the current level of net profit. The second factor is legislation, be it the Energy Act 2011 that will require a minimum energy efficiency standard on premises by 2018, or the mandatory carbon reporting that's required for companies that are listed on the main market of the London Stock Exchange that's coming into effect early next year. The rising tide of legislation will drive change within the market. The third factor is the broader social and environmental considerations that are exerted by different stakeholders, be they the employee, the shareholder, or even the supply chain pressure from above, which may soon be moving from carrot to stick in terms of the flavour of that dialogue. For different businesses, each of these three drivers will have a different degree of relevance. But in conclusion, I felt there's one factor that is ultimately relevant for all of these businesses, and that is the first of those, cost. Given the growing body of evidence that significant cost savings are widely available, maybe we'll hear about some of those today, what FD in the current environment would not be engaged by the prospect of being able to cut its cost base and hence add a few percentage points to the business's margin? We believe there's a compelling rationale to undertake energy efficiency measures, and the momentum behind these drivers continues to grow. And at RBS, we're keen to explore ways to provide finance to back these projects. Indeed, we have been taking our own medicine, taking steps to manage our own energy consumption, setting a target last year of reducing our energy consumption and associated CO2 emissions by 15% by 2014, and seeing firsthand the benefits of energy efficiency measures. So without further ado, I'd like to pass over to the panel and ask them to each maybe introduce yourself in a bit more detail and provide an introduction as to how your business fits into this market. Ewan.
Okay, thank you, Jamie. As Jamie said, I'm a partner in the energy team at Pinsent Masons, and I think over the last 15 years, we've seen various ups and downs around energy efficiency. 10 to 15 years ago, we saw quite a lot of energy efficiency work going on, lots of capital projects being funded by providers of energy efficiency solutions in a variety of forms, finding ways to help commercial industrial users fund capital improvements that would reduce their overall energy cost and find more effective ways of providing their energy requirements. And over over that period until about 18 months ago, I would say that work has largely dried up. Very little large-scale schemes were going ahead. People were not doing that, and that was largely a function of where gas and electricity prices were sitting. Over the last 18 months, I would say we've seen a lot of work going on around, particularly around what people are calling energy performance contracting, where commercial industrial players are looking at someone coming in and funding capital improvements for them based on the savings that those works will generate. And I would say that has very much largely been driven by cost. We'll come back and look at some of the drivers a bit later on. But the types of people that we're advising tend to be either large energy users, typically large commercial industrial players. We're acting for some of the contractors involved, and we've also been doing some funder work. And we've been helping a couple of funds that have been established to look at the investing in and providing capital for some of these projects. But one of the challenges that those funds are facing is they haven't got the project throughput that's going to justify them having funds under management. So a number of them are struggling. So we're seeing an industry that's coming back, having a real focus to it, but is struggling to get enough throughput and delivery to actually be perhaps sustainable in the long term, but something for discussion there.
Thank you.
I'm Paul Brewer. I'm a corporate finance partner with PwC. So I guess at one level, my starting point is in what Ewan's been talking about, how you fund energy efficiency measures or investments. But actually, my real starting point is a senior partner of our Edinburgh office and therefore responsible for the office and as an energy user. And that's, as for RBS, it's a really important issue for us. We are aiming to be and are just about there as a zero carbon business. Our new London office is powered by recovered fat and doesn't smell of chips, which is a success. And therefore, it's something that's actually quite strongly built into the consciousness of our organisation. And it's interesting how, going back a couple of years, our work in this area would tend to be on financing investments and therefore probably gravitating to the sort of larger bespoke efficient generation plant, CHP, biomass and so on. We're now finding that a lot of the work that we're doing is with developers and installers and municipal authorities looking at the business models that will actually help drive this out at scale and how the installation markets are going to respond effectively and bring the costs down of these investments and do it in a way that encourages, obviously with Green Deal domestic consumers, but also industrial users to take up energy efficiency measures and understand why they should. So we still do a lot of work on major investments, particularly in Scotland, I guess. We're acting on large-scale biomass, smaller-scale biomass for specific industrial users, and as those next door will hear in rather more depth, we're also very deeply involved off the industrial agenda in the Green Deal Finance Company. But all of this requires the finance. It requires new markets to be developed. Industrial buyers don't. There isn't a heat market. Industrial buyers are having to negotiate new deals every time they're coming across an opportunity like to buy heat in a different way. So there's a lot to form in this market to help, that needs to become more everyday business for it to gain momentum, as well as securing the finance to achieve investments.
Hi, Jamie. Chris Hayes. I'm a sustainability manager at Skanska. Skanska UK are part of a global construction, infrastructure development, civil engineering, wind power organisation out of Sweden. To put the scale of the business inside, we open and close around 50 projects a day globally. In the UK, we do about 1.5 billion a year and employ 4,000 staff, so we're quite a large company. My focus within Skanska is on new build construction, primarily, with some retrofit as well. Part of my role is putting the business case together for a greener, more efficient building than perhaps we're actually being physically asked to provide in one form of tender. And for our developments, we buy plots and develop our own offices and residential units as well, to look at the opportunities there to make sure that our products are as efficient and as green as possible, but also to frame that in a way that it adds value. So we're not just doing it because it's green and it should be the right thing to do. We're doing it because it makes sense, it makes commercial sense, it makes environmental sense, and socially it's the acceptable practice. So I'll come on to some of the projects a little later.
Afternoon, Jamie. Thank you. Malcolm Snowy, as Jamie said earlier, was managing director and co-owner of Snowy Holdings, which was a waste management company that employed 300 throughout the UK. We sold that in 2005, and we've started Scott Heating 2 years ago, mainly to look at the provision of heating for commercial customers throughout Scotland and the north of England. We supply boilers from 50 kilowatts up to just under a megawatt, which allows us to utilise RHI to its best point. Initially, when we started the company, the one question that we were always asked was the quality of the fuel. If it was a pellet installation, pellets are all produced to a very high standard specification. There wasn't a problem. However, with wood chips, they were either too big, too wet, too long. There was a lot of problems. So we have spent quite a bit of money, and we have our own wood chip processing yard now, and we're currently supplying throughout Scotland between 15 to 25,000 tonnes a year to various different companies. Going forward, we'll probably get a little exasperated at the moment. We've flung quite a bit of private money at it, and it is going forward. We have got a lot of happy customers, but there is still quite a bit of nervousness with customers, probably just on the main two fronts. One, will the RHI continue? Is there enough money? What happens if it stops? And then number two, where do we get finance? The installations that we're looking at typically range anything between £100,000 to £250,000 per installation. And for a SME, small to medium-sized company, even if they are spending £50,000 a year on fuel, and we can save them 20 to 32%, which is 10,000–15,000 a year, they still don't want to commit themselves to a £200,000 spend, because the banks will not finance it. So we have got these two things that seem to be slowing the thing down a bit. So hence we're all sitting here today to see if we can solve the problems.
And how do you see the dynamic there working in terms of the RHI and the savings? Can you give a bit more colour on that whilst we're on the subject?
The main dynamic that we see in that at the moment is the growing energy prices. Where we can go into a large hotel, so somebody who's using, I'm trying to get the numbers right, a large hotel who's burning anything from £50,000 to £100,000 worth of oil per year will save up to 20%. So they've got a saving of up to £20,000 per year. If we take it to the top end of the RHI scale, which if we go to a distillery, somebody using 2 to 3 megawatts of heat, they put in a 950 kilowatt boiler producing either process heat or steam. They have then got an RHI payment coming back to them approaching £157,000 per year, and they have a fuel saving of about 120. You know, those are all adding up into big, sensible, lumpy numbers, and at that end of the scale, it all does work.
And that's, sorry, on an investment of?
That's on an investment of anything between, and you know, be careful, the man sitting next to me has probably got a better idea of prices. The price is all very project specific. It depends on where it is. It could be anything between 600 and £1 million once you're up at that scale.
Yeah. So quite a rapid payback. When you
so the paybacks that we see on the very best projects can be 4 years. On the other ones, 7 to 8 years. So you're anything between this 5 and 8 year payback.
Yeah. Okay. And in terms of I guess let's break it down into component parts. In terms of the main drivers for change, I gave a summary of the three that I tend to have in mind when I think about the market. Ewan, would you have anything to say about those? Any to add, or any specific ones in there that you think are more prominent?
I mean, I think the common theme that's already come out of the comments that we've been making is that cost and savings is what's primarily driving people. It's an economic thing. To some extent, though, there is a legislative driver behind all of this. Certainly changes to building regulations and standards, the planning regulations, the Merton rule, where you're required for new developments to have 10% of on-site renewable generation, is providing some incentive towards this. And people looking to comply with the carbon reduction commitment, and also looking at increased environmental reporting standards and being able to show what you're doing in terms of carbon, and the reporting that's required around that is providing an indirect driver so that people can show that their behaviours are appropriate and are being they're taking account of the green agenda. So that's there as well. To add to that, yes, you've got things like the RHI, which are providing some form of support and subsidy for a number of these measures. So there is some legislation out there that's helping it. I think that's a secondary rather than the primary reason for the developments we're seeing so far.
And primary being cost?
Economics, yeah. People are increasingly concerned about energy pricing. It's a bigger aspect of people's overall costs, and volatility that we've seen in energy pricing, both electricity and gas, has had a bigger effect on people's businesses over the last few years than has been the case for some time.
Yeah, and it obviously, I mean, we see that with our customer base. Different customers have different energy costs, obviously, but the cost theme, it's obviously be it more or less significant. It's a number of percent of a cost base. So any savings you're able to make there are generally well received. Paul.
Yeah, I certainly wouldn't add any more headings to your three drivers. I think the social and environmental considerations aspect plays strongly in larger organisations where it can get driven from the top. Probably doesn't to the same extent pervade smaller organisations yet. So I mean, I'd come back to Ewan's point that the thing that speaks loudest to induce people to invest in energy efficiency is cost savings, and we're in an environment where I guess most businesses look at it on a year-on-year basis. They've got a good sense of the way that energy prices are escalating. They can see there's risk around there, but they perhaps don't have a coherent view as buyers of energy where that's going. And the more they can be educated on the bigger energy picture that influences its future cost, probably the more they would be induced to invest longer term in energy efficiency, because in businesses which typically across the economy are very restricted in investment capacity just now, putting a lot of resource into an energy efficiency project rather than a business business enhancement project or a product facing or market facing is actually quite a challenging decision for businesses to make, and the more they can actually be helped to understand the issues, the more likely they are to do it.
And I guess there you may have, if you've got longer paybacks, a bit more of a capex versus opex kind of perspective.
Yes. And I mean, to take it out of industrial, if you look at the sort of the economics of the golden rule of the Green Deal, where it's you need really quite low cost finance to make the payback period for energy savings in the domestic environment work. That, if you start to look at it in business terms, becomes quite marginal. Businesses are very keen to see these 4 or 5 year paybacks in the current environment, because the more business uncertainty there is around, the shorter payback periods people focus on.
And do you think there's, just building up on that cost point, do you think there is a unanimous view on cost? I mean, there were some statistics in one of the breakout sessions yesterday that I found quite useful that suggested that 3%, when customers were surveyed, 3% had thought that prices might go down. I think 6% didn't have a view or thought it might be flat, and 91% therefore thought it was going to go up. But are you seeing that at the coalface in terms of when you're
there's a mixture of issues. It's not just what am I paying for metered electricity. It's, well, actually, if I'm getting my heat from other sources, what should that be costing me? Because I can't see a market in heat that tells me what the price should be. So what you tend to see is arrangements on a negotiated basis, possibly with a guaranteed level of saving, but a lot of businesses just aren't aware to go looking for that.
Yeah.
And we find our clients coming for advice on just how should I be pricing this? And at the moment, that's a very new area for businesses that they haven't thought about.
Yeah. So maybe awareness is.
So there's a big awareness issue. Yes.
Okay, Chris.
Just to pick up and expand on some of the things you've already said, really, in terms of the price of heat. For me, it's linked back to how much would it cost me if it was coming from a fuel oil or from gas, and what's the difference? And the gas, in my opinion, is only going one way in terms of cost, and it's certainly not with the 3% that thought it might go down. I use a sort of a 3.5% inflation rate when I'm doing whole life cost modelling for buildings. At the moment, realistically, I could probably put that at 7%. So, what's the true value of the intervention? What's the true value of the fuel? To me, if you link it back to what the alternatives are, that's a very good place to start from. In terms of efficiency, the economy is not growing, or if it is, it's only in certain areas and it's very, very slow. So, good organisations that had or have a bit of capital invested that in making their businesses more efficient. So, you can't invest in growth because the market just isn't there to grow into. So make your businesses more efficient and your margins should improve that way. So that was one way to go around things. Those opportunities are probably less so now. But if you look at some of the targets and measures that have been thrown around over the past couple of days, people are talking about 90% carbon emissions by 2050. From my perspective in the construction sector, 80% of the buildings that are going to be around in 2050 are already built. So there is opportunities in new build, and there is opportunities in what we're currently developing and putting out there, but there's a massive opportunity and a massive issue perhaps in what's already out there and what's already built and making that more efficient. In fact, Skanska were up here, I think in this room 2 years ago, saying the same thing, but here we are. So there's the political will of realising the problem, the scale of the problem, and how do we make those buildings more efficient, and then let's think about how we get heat and power into those buildings to get to where we need them to be.
And just picking up on that efficiency point, do you think the people that you're engaging with, do you think they are hearing the efficiency language and thinking about it in that way? Because often it's a difficult thing for people to have to buy into in terms of paying a bit more, not going for the cheapest option, paying a bit more, although the running costs of that option, be it a fridge or whatever it might be significantly lower.
You have to communicate in the right way, so it depends on who you're talking to. So if you're talking about climate change, for instance, I wouldn't talk to my granny about the link of her flicking the switch and global warming and the torrential rainfall that they're experiencing outside, because it's not there, the link isn't there. So you have to talk in a language that makes sense to people. So whether that be the cost of the energy, whether that be the implications of regulations, building new buildings, more stringent planning controls. We talked about the Merton principle earlier, but the building regulations are getting more and more stringent. There's a new set in England coming out of 2013, and it's difficult to build to these really efficient standards. Technically it's a difficult thing to do. So using the right language, whether that be regulatory, whether that be cost, is really important. My work tends to come down to the cost argument, and sometimes that can be difficult if the contract is a lump sum type project. We have to be able to demonstrate somehow an added value, but in other circumstances where you're able to get into investable projects, there's a more opportunity for whole life cost arguments. So the appropriate technology, whether that be wood chip or whether that be chip fat, in this type of system is good for you because it's a local source. There's good continuity there. It's an efficient use of that energy in your building. It will work for your building, and it will pay back in 4, 5, 7 years.
Thank you. And Malcolm, from a coalface perspective, I mean, you're out there having these conversations, trying to get traction in the market. What do you see as being the main levers you can pull that get people's attention?
The main lever is just the commercial advantage at the moment, and to try and get people to see the commercial advantage, take it on. But as the rest of the panel have said, a lot of businesses out there this now, they're not making the profits that they were making 5, 7, 8 years ago. So if they have only got one lot of 200,000, 300,000, 400,000 pounds to invest, they don't necessarily want to put it into a new environmental heating system, steam system or whatever, while they've got an existing system in place, even although it's still costing them 20% more. We spoke to a large user the other day, and that was for a megawatt plant. They are not interested unless they can pay things off in 2 years, and we're not allowed to spend money unless it's paid back in 2 years. Now, that's wonderful. I mean, our background's agriculture, and things don't get paid off in 2, 3 or even 4 years. So they are still the main drivers, and I think as well, as Paul was saying, the larger clients do have their corporate responsibility. The smaller clients, yes, they know about it, but they're not going to do a lot unless it is physically saving them from day one.
Yeah. So do you think that, just building on that, do you think that's a function of where we find ourselves now in the economic cycle, where people have less resources available to themselves and therefore there's a bit more of a decision to be made, or do you think fundamentally that would be there anyway?
No, I think it's that, and I think it's still just mainly uncertainty going forward.
Yeah.
The other one thing that we have that we always need to remember, a lot of these biomass solutions are fine, they're very efficient, but they do take up a lot of space. The oil company comes in with a lorry, he will pour 3,000-4,000 gallons of oil into a tank. If we want to replace that, you need the equivalent of a supermarket Arctic sitting somewhere on the premises, maybe 2 of them to be changed every week. So there is that to look into the change in technology from oil and gas back to biomass.
And whilst we're on you, let's talk about the blockers to change, because you touched on some of those in your opening remarks, Malcolm. You were saying about questions around whether the RHI will continue, the renewable heat incentive, and what happens if it stops, and also access to finance. Can you elaborate a bit more on those?
I think the main, and it's not a blocker to the RHI, quite a lot of small businesses have picked up on the cut in the PV tariff. And a lot of people, they don't look at it as a cut. I mean, I look at it, the PV tariff was X, the cost of the installation was so much a kilowatt. The minute the tariff was halved, the cost of the installation halved. So it still came back to the same numbers. However, a lot of the public have picked up that tariff was cut. And that it's taken a whole raft of confidence completely out of the equation. Look, the question is, look what they did to PV, they stopped it. And you've then to go back in, explain that it wasn't stopped, it was cut. Once you're tied into this, you are tied into it for 20 years. I sat having lunch with somebody today, and I'm standing saying to the customer, once you're tied into the RHI, you will get it for 20 years. I said to the well-known chap today, would you mortgage your house on the RHI? And he laughed at me and says, no. So that maybe answers that bit. And if we come to the number 2, the finance, I will ask you, Jamie, I'm going to put a £750,000 megawatt unit into a distillery. Will you give me the money? Will you?
I'm asking the question.
Or do I need to give you £2 million worth of title deeds, and then you'll maybe give me the 750,000?
Yeah.
That's where we are.
Yeah, and I think that's a valid question. So I think obviously each case from a banking perspective depends on the detail. I'm not meaning to get away from ducking that question, but really I think what is the case, and I can speak for RBS here rather than the wider banking market, but I think there are a lot of similarities throughout the market. Is, you know, the banks are looking at this space very closely and trying to change the way, taking a fresh look at it. You know, that's why I've recently come in to look at the space to try and give some more focus around the strategy and build out the strategy and work out, you know, challenge decisions that have been made historically. And I think, you know, I think it's fair to say that I think you raise a good challenge. You know, if the technology is proven, if the technology is proven, and obviously that can depend on the detail, but if the technology is proven, then I think you're right to challenge the banks to have a look at how they structure that lending. But you know, I guess what I see from my experience looking at biomass, you know, when we look at larger projects, yes, we do fund biomass projects, and we do that around a project finance basis. But at certain points, when you get below a certain scale, they're no longer kind of viable to do it on that basis with that level of leverage because of the cost of diligence. So again, it does, coming back to my original answer, it does kind of depend on the detail. But I think you're right to challenge how we do look at that. Mm-hmm. Okay, so you're coming back to your original point about the RHI and the certainty. Is the point there that the fact is there is a degree of certainty, but people still don't buy it, still don't trust it?
That is the feedback that we are getting from quite a few sectors at the moment, and I don't know whether some of them think it's too good. You know, some of them, you know, I don't know, but we do get this uncertainty coming through. The other thing that changes with biomass is against both PV and wind, you know, and probably from your side, from the bank side. If the bank finances PV or you finance wind and the customer runs out of money, goes out of business, whatever, you can still take over the windmill and the PV panels. You can go to a maintenance contractor and say, look, give me an annual maintenance contract for 2.5 megawatts of wind turbine, and so long as the wind blows, you will collect the money. The payments are also assignable to the bank. That is not the case with the RHI. The payments are not assignable, and if the customer doesn't purchase the heat in the first place, there's no RHI comes back in. So everything comes to a sudden stop.
Yeah, would you like to comment on that?
Well, I think that's always been a key issue with heat elements around any kind of project of this nature. You know, heat by its nature cannot be transported over large distances and retain its value. And if your demand for heat disappears, and quite often energy-intensive users are in industries which are quite cyclical and can be affected quite badly by where they are in that particular cycle, and it's difficult to get investors or funders comfortable that there's going to be the revenue stream that's coming from heat that you've anticipated over the life of the project. And you know, that affects small scale heat in schemes, and also affects large CHP schemes, and it always has. So unless you're very comfortable in the financial covenant and demand of the heat off-taker, it's difficult to rely on that as a steady income stream over the life of a project. Which is why you come back to that short payback period. It's important to not just those who are making the investment decisions to proceed and only having authority to put in measures which will have a short payback, but it's probably also important to those who are lending and providing investment, because the longer picture for some of these projects is difficult to predict.
Yeah, and that's definitely from a bank perspective. Obviously, when we're looking at these measures and looking at what we can fund, be it retrofit, you know, payback is central to that. Obviously, because of the banking market, in terms of what, you know, not all measures, you know, you won't be able to find 9-10 year debt. You know, the debt markets tend to be 3 to 5 years, so that has a factor in terms of the measures that you can then consider. Paul, would you like to talk about the blockers you see?
Well, I mean, we've been covering quite a diverse range of potential investments, and each has its own set of issues. I think things to do with buildings and retrofit have a lot of practical challenges. They're invasive. Potentially, you need to be a long-term occupier. You need to know you're going to be a long-term occupier to get the payback, and the benefits, as we were saying, haven't been well sold. And I'm sure Chris will have the practical experience of how you actually sell the case for that. When you're looking at investment in renewable generation plant, biomass or heat sources, it's just issues of unfamiliarity, scale of investment. I think this issue of there not being a market in heat and having to negotiate quite complex contracts, which I'm sure sort of Pinson's will help support people through that, but the customers will be used to buying their energy on a very simple basis. And now you've got a contract that thick with lots of stuff about indexation, backup arrangements, supply guarantees, because this is a new source. How do I know that the feedstock's going to be there forever, and so on? It just introduces a layer of complexity that people have to get comfortable with. And the more that Malcolm is successful, I think the more it will help the market. But at the moment, all these dimensions of complexity and unfamiliarity, I think, give a barrier that people have got to get past before they'll make these significant investments.
So what can we do to get past that barrier? Is that just a matter of time? Is it waiting for the momentum? Because from my perspective, coming into this relatively fresh, it feels as if you've got all the drivers there behind, but kind of it's almost like the market's waiting to hit a tipping point where maybe it'll start to snowball, and that tipping point might be imminently. It might be a year, 2 years, 3 years out. I mean, I think as you get closer to 2020, 2018 with the Energy Act, there'll be growing pressure.
And about 4 years ago, we did a Europe-wide survey on the impact of carbon reduction legislation, and people said basically it is black and white. If you've either got to do it, or for example something that's associated with planning requirements, or there is a huge economic penalty, it works. If it's sophisticated and takes a bit of understanding, it doesn't, or at least it doesn't work nearly as effectively. So there's a very difficult balance to be struck in legislative stakes. I think there are a lot of organisations like the Carbon Trust who are doing what they can to provide sort of carrots of understanding the benefits, and I think there needs to be more of that. There's undoubtedly a role for the Green Investment Bank to promote its exemplars and successes, and the fund managers that they've appointed in energy efficiency, I think will be good evangelists. Getting people to understand the investments, because they really do understand from a business and a user's point of view how they work. But I think it's just got to be a build up of the noise and things like that. I don't think you can take the horses to water, but as we've been discussing, they're significant investments, so you can't make them drink.
No, that's what we're finding. And Chris, from your perspective, first hand, Skanska, I mean, could you give us a bit more colour on what you've seen as being
absolutely blockers? And there's a couple of things but the all boils down to one issue for me, and it's confidence, and that's confidence in the technology. Is it going to do what we want it to do in a way that we expect it to operate, and confidence that whoever's paying for it is going to see some sort of return on their investment. So it's confidence is key. And there's a couple of ways Skanska have gone about overcoming that barrier. So if I take the technology side first, we've invested quite heavily. Our Hollywood House office in Woking, we agreed £4 million worth of work with our landlord Prepim gave them confidence in the return by signing to a green lease for 15 years, which gave them the confidence to invest the money. We also invested some money in that ourselves, and implemented a whole raft of interventions to reduce energy and to provide green energy into that building. Funnily enough, heat, tying into the Woking district heating system was one of those. So there is a value for heat. You just have to be in the right place and near a good generator. So, you know, within that building, were the Prupim are now using the green floor that Skanska retrofitted as one of the marketing opportunities to attract other clients to that. So there's a benefit there for them. Within our retrofits, in terms of confidence in the interventions and the technology that you're putting in, some are tried and tested, so there's PVs on the roof. Everybody knows PVs work. You know, there's a good raft of data to demonstrate in the right settings that you're going to get a certain return on your investment. LED lighting getting better and better and better. So there's some very obvious things there. Some of the less tangible ones, so we started to use things like phase change materials. So these are materials that absorb heat when it's hot and release the heat when it cools down. This takes the peaks and troughs out of your office, makes it a better working environment. People are more comfortable working in those environments, which has other benefits. Now, it didn't have a lot of data around it. You know, the competence isn't quite there, so we're testing it ourselves before we go out and offer it commercially to our customers and our clients. So 32-week, £4 million investment in Hollywood House, and we're seeing the investment returns on that, 55% energy reduction, and a 55% reduction in water efficiency as well. So some tangible cost savings there, and the client was willing to invest from the green lease. Moving on from that, you know, again, because we've seen a benefit in it, we've done this in New York on the Empire State Building, in one of our offices there. We're doing it in Malmo on another Skanska office there, and we're just about to do Maple Cross, our head office, down in the outskirts of London, where we have a utility bill of £280,000 a year. And some of the interventions, one being a biomass boiler system, PV again, testing different types of LED lighting. As I said, the LED lighting is it's an exponential growth in the efficiency of some of the luminaires that are coming out and how the technology is developing. So we're using different types of luminaires in different areas of the building just to see how they work and how they perform. Again, gives us confidence to sell that to the client. So £280,000 a year is going to drop to £109,000 a year in utility costs.
You sound confident.
That we are that confident based on what we have experienced on other projects. And then on that, I've just put a business case together for our factory. Sanitation Skanska have a factory in Doncaster. So this isn't going to be a retrofit. This will be a new office and a new workshop that will be built in an efficient way. So not retrofitted, it will be built in an efficient way. It will be powered by green energy and PV, biomass again. And we want to get to a position where we are zero energy from the grid in that office on a net basis, so you know, contributing to the grid and the balancing off where we're having to draw from the grid depending on the time of year. We're hoping to get zero waste on that, 100% sustainable materials, and zero potable water where we don't need potable water, i.e., you know, don't process the drinking water and then flush it down the toilet. It doesn't make sense. And again, this is all confidence. We've got confidence now in our ability to do this. We've done it. We've seen the benefits. We're able to sell that to our customers, and we are doing that in certain circumstances. And it's breaking down those barriers.
And do you think customers are willing to take an element of risk there? Because I think that's what a lot of it comes down to, is what is the risk? And are they willing to take that themselves, or do they want to go down a route of an energy performance contract, for example, where you can get guarantees? And
it's completely, it's horses for courses, isn't it? And it changes depending on who your customer is. So if we look at the retrofit market, there is an appetite for energy performance guarantees. Skanska are, quite cash-rich organisation. We have an investment arm. We're willing to fund interventions, again, because we have the confidence it's going to pay back, and cross those barriers and hurdles that way, if that's the way that a customer wants to go. You look at some of the public sector organisations that we're working with and have worked with, and they're willing to fund it through other investment arms, whether that be through pension funds or whatever. And pay for the interventions themselves or through other finance, and we just install it and manage it to make sure that it's operating as we say it will operate, as a good contractor should. And also internally within Skanska, we have a small fund for internal investment, that we have match funding from CO2 cents. So we've got £200,000 worth of money there to invest on resource efficiencies internally, match funded, and part of getting the behaviours right in the business is, this money's there, and if you come to us with a technological solution to a problem that you think will work, you help us demonstrate that it works, and we will fund it internally with our money. So one of the things that we're looking at currently is heat recovery from high voltage cables. These large lengths of high voltage cables generate an awful lot of heat, and we're coming up with a way to recoup some of that heat and feed it back in and recover it.
It sounds very much as if you're trying to push the envelope and testing things. And
it's the confidence, as I said.
Yeah.
You have to overcome the confidence barrier. It's confidence in the technology, and it's confidence that they're going to get a return on investment.
Yeah, absolutely. Did any of you gentlemen have any more comments on the blockers or maybe solutions before I open up the floor? No? Okay, fine. We've got 10 or 12 minutes left. I'd like to invite you to ask any questions that you may have, any thoughts that have been prompted by the discussion. If you would like to ask a question, please raise your hand and we'll get a microphone to you. Right, we've got 2 questions. Lady here.
Can you hear me?
If you could, because it's being recorded. So thank you.
The Scottish Government having work on the climate change targets out to 2027. So I was interested in your comment about not being a heat market. And all the comments around that, and just wondered, what would your recommendation be to the Scottish Government, since we're sitting here, on what we should be doing or what we shouldn't be doing, that we are, that might encourage that further in Scotland?
Who'd like to take that?
I'll make an opening comment, and it picks up on the comment that Chris made as well, that of course there are some circumstances where there is infrastructure that allows heat to be transported, and that helps create a heat market. Where you've got one single isolated asset, of course there's no heat market, and that's difficult. So more that can be done to encourage district heating schemes, for example, which are a good way of allowing heat to be utilised in different areas. We've been involved in a couple of schemes up in Aberdeen where things have connected into an existing CHP heat network up there, and allowed different projects to benefit from that. That's been quite helpful. So one thing that the Scottish Government can do is perhaps help galvanise the public sector as users of heat, and in providing infrastructure to help a heat market develop in core areas, and also perhaps helping encourage industry where there are clusters of industry that could benefit from similar types of energy efficiency solution, to examine those and explore those. Those are 2 practical things that could be done, and I think to some extent possibly are already being done.
I think one of the things that we've seen in the little time that we've been involved in the market is nobody has ever measured heat before. Nobody knows what a kilowatt of heat is. Now this has now come in the past 18 months with the RHI. We've got very advanced heat meters that are coming from Denmark, Germany and everywhere else. Because if you ask anybody, how much heat did you produce, all they've got is a gas bill or an oil bill, but they haven't a clue how much heat there was, how efficient their boiler was. So we are now becoming a bit more advanced. We can now measure it and we can equate it, and I think that's got to be a big step forward.
To bring a financial perspective to it, I think heat networks are very well established in other countries, demonstrably successful, where they where you get that infrastructure established and you have heat users in the buying habit of buying heat. From a financial point of view, heat networks are potentially very long-term assets. You could have these pipes in the ground for 100 years, and to think of them as assets on which, when we've been talking about some of the more bespoke individual user investments, that you want a 5 to 7 year recovery, it just doesn't make economic sense. You combine that to that if you're incrementally developing out a heat network, you don't have any certainty about, in a lot of cases, about the demand that's going to hook onto that. So that's where I think there's an important role for government in helping initiate and perhaps, hopefully in an interim role, finance these long-term assets to help them establish, get their heat off-takers hooked up, and take some of the risks that I think lenders would have great difficulty with just now, because of most fundamentally the demand uncertainty. You leave aside the overlays of where RHI is going to be and so on. So I think it's an important role there, and I think that the focus of the REEF fund on renewable district heating is potentially a useful catalyst. Because it's renewable district heating, it's perhaps a bit more difficult to implement in the urban centres where biomass generation, for example, may not be the acceptable way forward because of air quality issues. But in smaller centres, in clusters around industry, in smaller settlements and so on, there potentially is something to work from there, and perhaps even with the relatively, in terms of scale, the relatively smaller end plant that Malcolm's dealing in, probably not many people thinking about how you take that heat and supply it a few hundred yards away at the moment. Perhaps you need that investment catalyst from the public sector to mobilise that kind of wider heat usage, because it's not something that would happen on the, coming back to the point, it's all driven by cost. It's not something that would happen just in the simple economics.
Okay, thank you. There's another question.
Howard Rose from Viant Energy. Well, a question really for you, and I think that might impact Malcolm more than most. It's to do with due diligence, getting across some of these hurdles. You can be looking at a cost of due diligence for a substantial size scheme, clearing £100,000, and that's the primary barrier to many clients. I'd like to hear what Malcolm's feeling on that, and you, and what solutions that the legal fraternity and the accounting fraternity are doing to reduce that cost barrier.
Well, I think in terms of getting transaction costs down on some of these deals, then the more replication of deals we can see in the marketplace and more deal flow coming through is going to help with that. And then I think trying to make sure that the wheel is not reinvented time and time again, and that people taking projects to market in the first place, and principally end users looking to sponsor projects, have thought things through as much as possible and have tried to structure things in a way which is likely to mean that there are not issues that have to be sorted down the line. So a bit of early planning can help reduce costs at a later stage. But as we see more of these transactions coming through, I think deal costs will certainly decrease. And as people get more comfortable with the types of contract that are entered into around this, I think there is, if you look at energy performance contracting, for example, I think already we're seeing standard forms, or different users have different types of contract they want to use, but we are seeing a degree of commoditisation of that which is driving costs down. I think in other projects, and other heat projects in particular, that process is starting, but we're not quite there. I mean, Paul talked about contracts like this. In the larger projects, that's definitely the case. But I think in smaller projects, people are coming up with forms of contract which are slightly more practical and cost-effective given the size of the projects. But I think it's heading in the right direction, but it's going to take a little bit of time.
And you touched on structure there. I mean, one of the, not doing a plug for the bank, but one of the things that the bank's looked at in terms of how it can address that is in the SME space, launching a fund. And the way they look at lending around those kind of initiatives is very much taking the comfort from other aspects, security, for example, lending into, it was initially agricultural slant to it. So that, coming back to your structure point, is an example where you could look at it in a different way and still maybe achieve the lending without the need for diligence costs. I don't know, Malcolm, if you...
As Howard was saying, quite a lot of the projects that we're looking at, they're the smaller size, so therefore they don't stack up with a lot. We need to do due diligence. We need to know who the customer is. We probably take the wrong pragmatic view, and we'll look at the customer, and both the customer will take a commercial view on a lot of decisions, and I'll then take a commercial view on a lot of decisions, and that way we've cut a big raft of things out. But we're of a size, and we probably have total control on what we're doing, so we stand or fall on our own decisions. That it's not that we want to do it that way, but by the if you go and get two sets of yourself involved, then it slows down, it stops, and the customer will just say no. Because we're talking about things, you know, as you say, fuel supply agreements, fuel quality agreements and everything else. Even on quite a large installation, if we're looking at doing it on an escrow basis, which can still be anything between 200 and £500,000, the existing heating system will be left in situ. And it's left to the stage, we will put the equipment in, we will collect RHI, and I will supply you your heat. You're burning oil at the moment, your heat is costing you between 6.2 and 7 pence a kilowatt. We will supply it somewhere, depending on the size, between 4.25 and 5 pence a kilowatt. If we fail, switch and go back to the old system. That cuts out a big raft and it keeps it simple. So long as we can do that and we're in a position to do that.
Yeah, and that kind of arrangement can be documented very simply. I agree.
Yep. So long as everybody's got that pragmatic view, then everybody's happy, because we tend to be working with customers who can make the decision themselves.
Okay, were there any more burning questions? I think we've got a couple of minutes left if there were. But if not, I'd just like to wrap up by thanking the panel, Ewan, Paul, Chris and Malcolm, for taking the time to participate, and thank you for your questions. If you'd like to help me show your appreciation. Thanks, Thank you very much.